All right. I think we're working. Check. Is this thing on? Everybody here?
I think let's give it another minute.
All right. I see people coming in. Let me change the chat real quick and make sure people can do some chatting. Let's see. So panelists can chat. We'll leave that open for now. If it gets distracting or we get, weird people in there, we'll shut it down. But hello, everybody who's coming in right now. Let us know in the chat area where everyone's from. We've got over 500 people here already. So let us know in the chat area where in the world you're at.
Yeah, please do.
That's always fun. Yeah.
I wonder who's the farthest person away from us. Not that we're all in the same place.
All right, we'll give it another couple minutes and then we'll get this kicked off. We are excited. So for those that are just joining, we should have an awesome turnout. Should be a good time. And, we'll probably plan to kick off at 6:05. So give it another minute or two.
In the meantime, did you want to do that dance, Ken, that you've been working on, the TikTok one?
Yeah. I'm not quite ready. I'm shy, as you know.
The practice looked really good though, Ken.
It did. Thanks. That was
Brandon was hyping it up, and I think probably half the attendees here were here to see that, Ken. Come on.
Isn't that the upsell?
Oh, man, that was the upsell.
That's them wanting more.
Apparently, I don't have the chat enabled yet. Let me enable the chat.
Yeah.
Hold on.
Yeah, because nobody's chatting, and it's like,
apparently
everybody's putting it into Q&A.
Okay. Now I have fixed it.
There
you go. Let us know in the world where you're from. There
oh my God. They're just blasting away.
Wow.
Neal, you want to read them all?
Oh my God. Well, so far India flashed by, so I think that's longest from the pin. Boy, they're really coming in. Just everywhere, right? I've already seen just about every state in the country because we now have 700 people.
There's Guatemala. There's Canada. Neal, you're used to looking at a lot of information.
I know. They just it's going past so fast. Jesus. Wow. All right. I think there's Texans winning so far. I'm guessing
there's Puerto
Texans
Rico.
and Californians are definitely ahead.
You got an Afghanistan in there. I wonder how real that one is.
A lot of Texas, a lot of California.
Yeah. So for those of you just joining, just go ahead and type in where you're from. Just kind of good to see the good mix of people we have. A lot of Houston people representing.
Yeah. And lots of Californians. I bet you many of those are from our database. We have a very California-centric database. Let's see. Boise, Idaho. Well, that's a market we might want to talk about today. Welcome.
All right. Well, let's give it another minute and then we will get kicked off.
Let's see. Hey, Feras, you want me to tell kind of the backstory of where this idea came from?
Yeah, go for it.
All right. So we're sitting at lunch the other day. Ken was not there. I had lunch with Ken the day prior. So I'm sitting in Seattle with these other guys. And the four of us are sitting there talking about just like economics and the economy and all of real estate and how it is working, right? And we're having this great conversation. And then we started thinking like, man, we should have just like put a phone in the middle of the table and recorded this because this was such a great conversation. And of course, with Ken, the day earlier, I had the similar conversation with you. And
Ken was being channeled in through you, right, Brandon?
What was that?
Ken was being channeled in through you.
Exactly. I was just spouting Ken's thoughts. I don't have my own. So anyway, so we're like, I wish we would have just recorded this. And we're like, wait, why don't we just do that? Why don't we just do this in the next week or two and get the same group? So this started over lunch, a couple different lunches. And we thought there was a lot of interest in getting the other smart people and myself to talk about real estate. So it should be a good time. So
we're definitely excited. So as Brandon mentioned, this is something we're all excited about. I mean, it kind of came out of nothing 2 weeks ago and had all the right people and, all friends and hosts and people we trust and figured, hey, let's just kind of get the powwow together and really talk about what's going on. I know there's a lot of questions, a lot of uncertainty about what's going on in the market and figured just get a lot of different opinions, people doing deals, people underwriting deals, people talking to people doing deals, people talking to people to doing deals, a little bit of everything. So figured we would get everyone together and kind of really just do a little bit of a round table. And so for those of you that are just tuning in, we'll spend the next 45 minutes or so really just kind of talking through a couple of different questions, different topics, and we'll spend the last 15 minutes doing open Q&A. So if you have questions, we will moderate that. There won't be a lot of time for Q&A, so we'll kind of keep that brief, but I know people, at least me personally, whenever I attend these things, my favorite part is the Q&A. And so with that said, thank you all for joining. I'm Feras Moussa, one of the managing partners at Disrupt Equity. We're based here in Houston, Texas, and that's enough about me. I know you guys aren't here for me, so you guys are here for my friends on the show. So with that said, we'll go ahead and let them each introduce themselves briefly, and then I'll go ahead and moderate and ask some of the questions. So I guess let's see. Neal, you want to go first?
Absolutely. So run a company called Grow Capitus, data-driven data scientist. And I'm really here because I'm seeing the industry, the math is getting fuzzier than Brandon's beard. And so it's very important for us to kind of put the numbers in front of you and tell you what makes sense to us, and hopefully it makes sense to you. So really, really excited to be here.
Awesome. Thank you very much, Neal. And where are you based out of, for those that don't know?
San Francisco Bay Area.
Perfect. All right. Next up, Brandon, you want to go next?
Yeah, what's going on, everyone? I'm Brandon Turner. I was the guy over on the Bigger Pockets podcast for almost a decade. I wrote a bunch of real estate books, and now I run a company called Open Door Capital, where we buy mobile home parks, and then we partner with Disrupt here on a lot of apartment stuff. So Feras and I became really good friends through that, and we've been doing some business together. So, and then I got to know each of these guys over the past few weeks a lot better at different various conferences, and they're bright guys. So I'm excited to dig into your guys' minds today.
Awesome. And really quick, and where's home base for you, Brandon?
Maui, Hawaii right now. So I'm out here in Maui.
So if anyone's in Maui, Brandon's out there somewhere. You can go hunt him down. Next up, Robert, you want to go next?
Hey, everybody. Robert Helms, host of the Real Estate Guys radio program. We're kind of all over the world in hundreds of countries and stuff, but my home base is Dallas, Texas, and we spend every week talking about this kind of stuff. What's going on in the economy? Where's real estate headed? So I am really anxious to hear what all the folks have to say today.
Awesome. I'm looking forward to it. And for those of you who never heard Robert, he's definitely got that radio voice. So one day I'm going to work on my radio voice. And last but not least, Ken, the one that I don't know enough of. So I'm definitely excited to get to participate on this with you, Ken. You want to go ahead and introduce yourself as well?
Yeah, of course. Thank you. So this is our 20th year in business. We're MC Companies. We've got about 10,000 apartments. We've closed right around $3 billion in that 20-year period. We're active, very active right now. I authored all the Rich Dad books on real estate. So most of the ABCs of real estate, all those are from us and from me. And I know all these knuckleheads, so I'm excited because I think we probably all have these conversations individually in our conference group all the time, trying to figure out where to be, what to do, cap rates, interest rates, all the stress points. So I'm very excited about this as well, just being part of it. So I appreciate all you guys, and thanks for being here.
Thank you, Ken. And, for those that are tuning in, these people are just being humble. Like I said, everybody on this call is doing deals, done deals, new development, value add, BFRs, anything and every hotels and the lease, et cetera, et cetera, et cetera. So wealth of knowledge should be, fun conversation. So with that said, let's go ahead and just go straight to the elephant in the room. So I'm just going to toss out a couple of questions. Whoever wants to answer, and then we'll kind of go from there. First one, where's the economy today? Kind of what's going on, right? What are you guys each seeing, right? Respect to the types of deals that you're doing, right? And, what do you think is going to happen, right? Let's just say over the next quarter, right? In terms of job growth, rent growth, inflation, et cetera. Who wants to go first?
I'll start.
Go for it.
All right. So we're looking at about 7 to 10 deals. We looked at 7 deals today, actually, a week. And we look at a lot of deals, but by the time they go through our analysts, we get to about 7 or 10. We're seeing about 20% pricing discounts from the sellers right now. And we're seeing a big difference in expectation between the sellers and the buyers based on a number of things. One, primarily the interest rate. And there's a lot of variables in the interest rate. So if for example, today, if we're going to buy something on a bridge loan, of course, is a short-term loan. We don't know what the interest rates are going to be when we get through that value add. So that's becoming a problem for a buyer, because you either got to go with a straight Fannie or Freddie fixed long-term deal, which is a lower loan to value. And so there's a big disconnect between buyers and sellers right now. And so I see cap rates kind of going down as a result of seller expectation and buyer cash flow. So I dropped a deal. In 20 years, we've only dropped 2 deals. And I dropped one about a month ago. We were in escrow at $108 million. on a deal, and interest rates, we underwrote at 4, and they went up, as you guys know, and they have been going up. We were trending somewhere in right around 5. Just that 1% on 70 million was, a significant amount of difference in the debt payment. So we dropped it because our cash on cash went way down, even though it was a massive value add, and we were afraid of the exit cap rate. So I think a lot of people are concerned about the same things that we're concerned about. But I feel like the sellers are starting to just recently come to terms a little bit. And we're hearing discounts. I live in Phoenix, Scottsdale, Arizona. We're hearing discounts on some of the new construction because some of those guys are afraid of, what their permanent debt's going to be. So it's an exciting time if you're a buyer. I think, you just got to be patient.
Yeah. And good question. What markets are you focused in?
So we're in every market in Texas. We're in Oklahoma. We're in Nevada. We're in Arizona. So we're based in Arizona. We bought all over pretty much the Western U.S. except for California. Try to stay out of there. Other than that, we've been in most of the markets, and most of the West Coast. Got it.
Yeah, because we're underwriting a tremendous amount of deals, and we've seen that 5 to 10%. We haven't seen quite 20, so I'll be impressed to kind of.
That's our
20.
offer. Come on.
And just really quick, just a recap for the people listening. You said you mentioned they're going to go down, but I think you meant they're just going to decompress, is what you're saying, right, Ken?
They're going to go up.
Well,
cap rates are going to go up.
Yeah, so we always solve like you guys. We solve to cash on cash for our investor. That's at the end of the day, that's all we're trying to do. So because the debt costs are up, rents are up too, but expenses are up too. So but we're solving the cash flow, so we back into the offer that way. And if it's a 3 or 4 or 5 year hold, we don't know what rates are going to be. We don't know what cap rates are going to be, interest rates and cap rates. And so that's the risk if you're buying.
Awesome. Who else wants to add to that?
Well, I don't have anything to add on the real estate side, but the part of your question that was interesting to me was around the economy itself, right? So I'm going to just stay completely away from real estate and share some insights on the economy outside of real estate. We are in an economy that is currently suffering from a really bad case of multiple personality disorder. So this is a bipolar economy. And what I mean by bipolar is, on the one side, you have NASDAQ down 22%. You see, you see the velocity of single family homes, falling, especially in June. They fell a lot. July seems to be even worse in terms of home sales volume. Velocity is falling. We're seeing all the things that Ken just talked about. So you're seeing that as a negative in the economy. But then on the other side, we're seeing one of the most bizarre circumstances that I've ever seen in years and years of watching data. Number one, the economy in the last 3 months produced 1.2 million jobs, even though GDP was negative in Q1 and Q2. So we have an economy with negative GDP, 6 consecutive months, producing 1.2 million jobs in the last quarter, which is double what it historically produces in good times. So some of the fundamentals of the economy are incredibly good. 5.1% is the salary increases that the average American is seeing. That's 2.5 times what we were seeing in quote unquote good times in the 2015, 2018 timeframe. So we're seeing some numbers that are awesome. Like, these are the sort of numbers that the Fed would be having parties over. And then you have all these other numbers, including negative GDP growth. So the economy is currently suffering from serious bipolar disorder.
Completely agree. It's been interesting and fascinating to see. But really, to add to that, though, what do you think is going to change in the economy over the next 6 months? Right, that's probably a good segue to the next question I had. And that's for you, Neal.
Oh, it's for me. Okay, all right.
Yeah,
so
you kind of said what you're seeing now, but what do you think? Where do you think that's leading to? Right.
Well, so the short answer is, that part, there are 2 scenarios in my mind, and I want to share both of those, right? So the more likely, or the highly likely scenario is, I expect the US economy to get closer and closer to recession each month, but I don't expect it to be in a real recession. We are now in a technical recession before next year. Why? Because unemployment is too low. It takes a long time to get unemployment from 3.6 to 5%. It's extremely rare for the US economy to be in a real recession when unemployment is below 5%. It's going to take a while. Currently, the economy is fighting the Fed, and it's fighting really, really hard. It basically is trying to ignore what the Fed is trying to do, which is to slow it down. And so far in June and July, it's doing a really good job of ignoring the Fed. So the Fed's really in a fight. But I still think that the Fed wins. I think that job losses and layouts will accelerate as each month goes by. The unemployment rate will rise. And then Main Street's remarkable income growth is going to slow, and it might even go backwards, right? And the process is not going to look any different from past recessions, except for 2008 and 2020. Those were both black swan events, so they were much more painful. So I'm hopeful that this is what's happened. So, and I'll explain this later. I am rooting for a recession, because this kind of forced recession is the kind of recession that no one should worry about. There's three kind of recessions that happen in the United States. The other two are much more dangerous than the kind of recession that we are about to go through, because this is a forced recession. It's one that has nothing really to do with the economy's fundamentals. Now, before I jump, hand the mic back, I want to mention the less likely scenario, because I'm sure I'll get questions on it. The less likely scenario involves geopolitical risk. If the Russians choose to cut off natural gas supplies to Europe, which could happen very quickly, worldwide inflation is going to spin out of control. Oil will spike to well over $200 a barrel. At that point, smaller economies are going to run out of dollars to buy oil, and they're going to start defaulting. So 2 weeks ago, it was Sri Lanka. 2 weeks from now, it's going to be Pakistan. So it's already bad enough. They can't really afford oil at 130. If oil goes to 200, then we could start seeing financial contagion in the world economy. So the one thing I worry about today that has nothing to do with the US economy, we are easily the strongest in the world, is that pipeline that's going to Europe. If it gets turned off, then we are in a situation that the Fed doesn't control.
Yeah, and I do want to maybe add one quick thing to that too. It's kind of really the point you made about forced recession, right? And there's kind of an interesting article I was reading, and it was talking about West Berlin versus East Berlin. Right, where East Berlin, it basically stayed, growing each year after year, right? And so continuing kind of consistent growth versus West Berlin, which is more traditional kind of to our economic cycle, right? Which basically you get the rapid growth and you get the softening and kind of the forced, whether it's forced or not, right? The pullback and then the growth and the pullback. And really across the two, the West average obviously significantly more. So it's kind of interesting to think about for those and more of the bigger picture. And so maybe I want to shift this over, Brandon, to you a little bit, right? You talk to a lot of people. I mean, you're very well, in tune with what people are seeing, both, friends and other listeners. What would you say most people kind of are giving you perception-wise, right, in terms of their expectation of what's going on in the economy?
Yeah, man, couple thoughts. First of all, I think that most people I know, now granted, my friends are not necessarily the average American, right? Like most of my friends are in real estate or some kind of finance world. But when I talk to people at conferences or events or where I go or online, I feel like everyone kind of has this vibe that what we're going through now is because of bad policies, or maybe not even bad policies, just because of the policies, because of COVID. And we're going to dig out, but we're going to see a dip. I think everyone expects some little dip to come. I don't know anybody who's predicting like the end of the world is happening next month and real estate's going to drop 50%. Like I don't hear that anywhere. I don't know if you guys are hearing that, but like there's not a lot of like loud shouting that the world's ending because of this. Because again, I think we all just thought it was a really weird couple years. So when I see like, when I see that, and I see so many real estate investors that are eager to buy and they've been so wanting to buy for years, when we start seeing the 5, 10, 15% dips, I just see a lot of people, just those people jumping in and then trying to buy, which kind of alleviates a lot of the drop. Also, the iBuyers maybe will actually start making money again if they can start paying a little bit less, which may also pick up some of the inventory. So I don't see that, based on what everybody I'm talking to is just almost excited about it. Now, granted, when people are in a free fall of an economy, then there's a lot of fear. Nobody wants to buy anyway. So I guess it depends on how fast we drop. But at the end of the day, the last point I'll make is like, and I'm sure most of you guys would agree with this, but like when for like a decade now, right, I've been reading like people give financial predictions about what's going to happen next. And all people that I really like and are very smart and very talented, and they're almost always wrong, right? Like almost always wrong. Once in a while, people
Very
get things
true.
right, but there's so much. It's like the what's the whole story of like the monkey throwing darts at a stock picker, like stock board, and like they outperformed all the best stockbrokers in America. Like it at some level. Like we just can't control and we can't see, no person can see everything, right? We can see trends. We can see, hey, inflation is here and it's likely going to continue. So when I think of real estate, I don't let fear like cause me to go, okay, well, I'm going to just do nothing for the next 15 years and just sit around because I don't want to be that guy. But I'm also thinking like, okay, what are those big trends that are happening? Where are lots of people moving to? What type of real estate could do well? Should we see a decline in rent by 5 or 10% or decline in house prices by 5 or 10%? Not that I expect it, but where can we survive through that? And then how can I build the best team possible? Because at the end of the day, again, we don't know, we don't have crystal balls. So as long as you're looking at the positive trends, you're being smart about it, you're nimble, meaning you're changing as new data comes up and as you hear from smart people talk about it, and you have a good people around you, I think you'll be mostly okay. I know it wasn't quite the question, but
no. I think it answered the question. And maybe to summarize it very succinctly, right? Real estate is not a get rich quick scheme, right? If you play for the long term, right, let things ride out, and make the right kind of upfront data driven decisions. Probably be safe. That's kind of that's the thesis you subscribe to, right, Brandon?
Yeah, and to add on that, I'm taking over the moderating here because that's what I do. But Robert, would you mind? I know you don't have your slides, but Robert, weren't you the one at the conference who had that? Maybe it was Neal. I think it was you, Robert, that had the slide of all the quotes about real estate about the fall.
No, it was Robert. And it was funny.
Yeah,
I was
Robert.
Could you speak to that, Robert?
Robert, if you could pull them up, if you want to read those quotes, I think people would really appreciate that.
I don't know if you have that handy.
Because I was going to ask Robert for his outside perspective, kind of seeing, again, just outside of the economy, right? You were talking about the U.S., but, Robert is obviously very, very invested in other countries. So would love to see also what you're seeing there too.
Yeah, so I think big picture, and this is all great stuff. And hopefully your mind is whirring, like there's so many things to pay attention to, but not to the point of analysis paralysis. I saw somebody in the chat say, should I wait to buy? Well, that's the question on everyone's mind. Do I wait and try to buy when things are lower? Ask yourself, how does that usually work out for people? Whether it's the stock market or oil or gas. To your point earlier, none of us can predict the future. I'm pretty good at predicting the past. I can figure that out, but we don't know what's going to happen. I share Brandon's sentiment. I don't think we're talking about a crazy 50% drop in people standing in bread lines, but I do think there are some fundamental changes. Ask yourself this: do you wish in the last 10 years you had acquired more real estate? If the answer is yes, then I'm betting there were a lot of times where you could have bought, and for whatever reason, you were scared of this or that or the other, or the sky was falling, you didn't. We tend to regret the things in life that we don't do a lot more than the things we do. The best thing about real estate is it serves a basic human need. One of the things I often talk about is that you can sit out the stock market, you can sit out the metals market, you can sit out bonds and mutual funds, but you can't sit out having an economic relationship with real estate. You may not own, but you're going to pay to live somewhere. And that's what makes it unlike any other asset class. So I'll pull those quotes up here, and these aren't mine. These come from Gary Eldred's awesome book. But
Brandon,
we've been
start
talking
taking
about
notes.
these for a while. So here's the quotes that I ended my presentation with when many of us were together in Seattle. And it's entitled "The Experts Agree." And so the experts are a bunch of journalists. Time magazine said the prices of houses seem to have reached a plateau, and there is reasonable expectancy that prices will decline. Science Digest said houses cost too much for the mass market. Today's average price is out of reach of 2/3 of all buyers. Business Week said the goal of owning a home seems to be getting beyond the reach of more and more Americans. Money Magazine said the era of easy profits in real estate is drawing to a close. And the Miami Herald said, if you're thinking about buying real estate, be careful. Rising values are not a sure thing anymore. Those are the quotes that were said in 1947, 1948, 1969, 1981, and that last one in 1985. So the point is, I always give my friend Peter Schiff a bad time about predicting 19 of the last 2 recessions. Everyone on this call today is going to wish they owned more real estate 10 years from now. you're going to wish you'd figured out a way to buy it. So I think we want to be careful. We want to pay attention. I love watching Neal present because he is so data driven. You got to get your mind around that stuff. At the same time, it's not about do I or do I not. It's about how do I react given what's happening. You know, the Fed raised rates this week. That's big news. What happened to mortgage rates? They went down.
Went down.
So you can't, none of us can figure out this stuff. We call it the squish. You know, you take a water balloon and you squish it and you don't know quite where things are going to stick out. You don't know exactly. And that's the kind of economy we don't know. But one thing I know for sure, there's not a technology coming down the road that's going to eliminate the need for human beings to sleep under a roof.
You definitely haven't watched The Matrix, but Robert, love the kind of the background. I think, again, that's everything you said. I think we all agree with, right? And so really quick show of hands, anyone here on the call is scared to do a deal right now? You know, if a deal presents itself, any of the 5 participants? No, right? And so kind of, again, well, all right.
I am. And my answer is, I want to wait for that next 2 to 3 months because like Ken, I'm seeing buyer expectations, seller expectations change, but I would basically just want to wait for the next 2 or 3 months before I buy. So it's a very short window during which I'm afraid because I think the adjustment's coming. One shocking piece of information with all this hoo-ha that's happening, the Fed talking, threatening to do this, and there was a war being fought in February. In Q2, cap rates for multifamily did not adjust one bit. They did not go up at all. I checked the CoStar data and I checked RealPage at the conference. You guys were all listening. There's been no adjustment to cap rates at all in Q2. That's because everyone closing deals in Q2 was buying them in Q1. There's a lag. And so, right? So right now, there's actually no data to present to buyers that, hey, cap rates have basically increased. And there's no data to tell sellers that. So we have to have 1 quarter where we start seeing actual charts and graphs being sent out by CoStar and by RealPage that say, look, there was an actual increase in cap rates. We know it's already happening. Ken knows this, right? Because there's offers, there's properties in contract, but not until they sell will the expectations adjust. So it takes 2 to 3 months.
You said exactly. Literally, I had a conversation yesterday with a broker, and he said we're finally almost done with the clean out of where there's this huge disconnect between buyers and sellers, right? And people that are already pregnant with deals and or sellers that are going in with 2-month-old expectations, right, and not really knowing where the market is. And he literally said we're finally starting to list the deals where essentially you have sellers that, yeah, there's uncertainty, but they get it. It's not what it was back in, March or February, right? So I think it's exactly where things are at. And so then maybe shifting gears a little bit. So,
can I
anyone on the
real quick, Feras?
Go for it.
Sorry. I just wanted to make one quick point because I get asked this question all the time about should I wait to jump in? And like Neal just said, it might be 2 or 3 months. You can totally do that. My encouragement to everybody, though, is don't right now in your work. And I know none of these guys are. Like I see them working hard to still look for deals. Just they might not, like Neal, you might not buy one, right? But don't ease off your skill set. Like still analyze deals.
No,
run
not at all.
You never know what might come up.
We're underwriting the same number of deals that we were 6 months ago.
Exactly.
Yeah, no, the biggest mistake we made during COVID was letting off the gas.
Yeah, people use the economy as an excuse to not take action, right? So, and the way you know if that's you or not is, did you stop doing the work? Regardless of the economy and whether you're actually going to buy something, did you stop doing the work? And the answer from majority of people is yes. I stopped doing the work during COVID. I stopped doing the work when interest rates ramped up. So that's just kind of a good internal gauge on, like, do you really want this?
Yeah, and that's a perfect segue to my question, which is ultimately, how do people protect themselves, right? If you're looking to do a deal in the next 6 months, what should people keep in mind to help mitigate risk, right? And I think ultimately we like to say deals are all about really financial engineering and mitigating risk, right? Time helps, solve all problems, but you really need to kind of go in mitigating risk along the way to help kind of give you that time, right? And so, and maybe this is a question for Ken if I have to pick somebody, but who wants to kind of hop in and really, what are the things people should keep in mind? And I'm going to ask it twofold. If you're doing large multifamily, right, is one thing. And if you're doing other projects, right, I want to really not minimize that other people, because I know we're really heavy on the multifamily side, but, that's maybe the 2 questions I'd like to ask.
Sure. I would say 3 things. The first one is, if if you're buying for cash flow, so I got caught in 05, 06, 07 buying in Austin. Believe it or not, Austin went down after that. And what saved me was cash flow, occupancy, cash flow. So I think that's very, very, very important. And so there are things that you can do to fix your debt and make sure that that you have plenty of reserves. The second one is, of course, that you need that fixed rate debt. So the big variable, we know that there's a massive gap between the 9.1% inflation and the 2% target that the Fed has. That's a 7% gap. Now, who knows what it'll be here in the next 60 days, but they are going to meet again 3 more times before the end of the year. And of course, we don't know what that's going to do to rates and all that kind of stuff. But the borrowing cost, the Fed funds rate does have a chance of going up. So what does that mean? That means that if you're going to buy, that you really do need to fix your costs on your mortgage. That, in other words, that's the only thing I would do, because if I'm trying to time the market on interest rates later, I think that's risky for not only myself, but my investors. And the third one is that I believe that you definitely need to have cash reserves. So you know, if you are taking a risk, let's say on bridge debt or even a massive renovation, we have 68 million in renovations going right now. And we also have 250 million in new construction. And so we're having budget busts on those, you know, from the labor and the supply chain issues and those kinds of things. So the reserves are very, very important as well. So, you know, I would say cash flow versus capital gains, fix your debt and have some reserves. If you do those things, and by the way, I've done this, I've been through this, I've been through, you know, 05, 06, 07, 08. I made most of our money on our assets in 9, 10, 11, 12, when we were buying pretty aggressively using Canadian, basically 401k money or RSP money. And we did very well. We have a lot of those assets still. And you just got to be able to weather the storm. We don't know where this is headed, but all of this, we still have a 5 million, somewhere around 5 million unit deficit in the US at least. So there's a massive gap between what, you know, the supply that's needed. And I see pretty aggressive rent growth in the next few years. So I'm very bullish on rent, on as a landlord, as any kind of housing provider.
No, I completely agree. And I think I'm going to reiterate that to people on the call. Reserves. We've been there where we had reserves too tight, and you start to learn that investors will not be disappointed if you presented a 14, but you raised more money. So therefore it became a 13, right? They will be fine. They will be disappointed if you have to go to a cash call. So, you know, really plan for those reserves. We don't know if this is going to last the next 2 months, 6 months, 2 years, but it's about having enough cash flow and reserves to just weather the storm and come out on the back end.
Yep. Cash, because you don't know if that cash flow that you have now is going to go away. So the key messaging is educate your investors. And if you do that job, you can pull your IRRs back by 10%. So maybe you were at 15, now you can be at 13.5. All of that delta needs to go into just cash. Be very cash rich.
And really quick, so one thing, Ken, you mentioned, you know, fixed rate. You didn't really talk about cap rates and floating. Right. I mean, what's your thoughts there? Because historically we've sold a lot of deals, and trust me, we paid millions in penalties.
Yep.
And so bridge, you know, it's an attractive option, especially if you can buy down the cap. And I'm curious who here has any feedback on that. I know that's probably something on a lot of people's mind right now, given where the market is.
Well, when I first started my career, let's say in the 30s, I used to buy, fix, sell, buy, fix, sell. And I learned that after doing that enough, that I didn't really own any real estate at the end. I paid a lot of capital gains. I made a lot of money, but I didn't own any assets. So our philosophy has always been long-term hold. And so for us, you know, obviously we want caps on our interest rates, but to try to mitigate that if we're doing the floaters. But what we're doing even today, we made offers on 2 projects today, and we're just going to do a 55 to 60% loan to value Freddie or Fannie deal fixed and then just ride it out for the coupon, the cash flow over a long period of time. And they're value adds, but we're going to do 7-year terms, and we'll probably do a cash out refi, toward the end.
Yeah, I completely agree. I think there's a phrase Brandon and I were talking about back in Seattle. It's, those that are rich sell, those that are wealthy hold, right? It's really building true wealth over time. I love that phrase. I think it's kind of the embodiment of what real estate really can and should be. Did anyone else have anything else they wanted to add to that before kind of shift gears a little bit?
No, I think Fannie Freddie floating debt is the way to go today. I'm obsessed with studying the economic cycles in the US. And there 9 times the Fed's raised rate in the last 61 years. All 9 times they went up fast and they went down fast. What most people know is that the Fed's raising interest rates. But has anybody actually studied to see what happens when they finish raising rates? They don't just sit there, they drop rates. The Fed's job is to gut punch the economy. The job is to bring the economy to its knees. Then the Fed has a new job to pick the economy back up. So when rates go, I believe that no economy in the US, and the US is the strongest economy in the world, no economy in the US can live at these rates for more than 6 months. One time in the last 61 years, the Fed made the mistake of keeping rates high for 9 months. We ended up in the 2008 depression. They did that once. They are very smart. They know that they made a huge mistake there. We're going to go up. We're going to go down. I don't exactly know when the peak is, but I know that there's going to be a quick return to normalcy at that point. And hopefully by that time, the Fed kills inflation. One number to remember, the Fed is incredible at killing inflation. They have a fantastic track record. What they have a truly awful track record of is preventing recessions while killing inflation. They've only managed to do it once time in 61 years. So I know they will kill inflation. They'll do whatever is necessary. But I also know they'll put us into a recession. That's not necessarily bad, because as syndicators, we want that floating rate debt because we know that if rates go up, they will go down. And so if you have that belief that they'll go down in 18 months, which is my belief, then it makes sense to have floating rate debt and give yourself the ability to refinance later. That's what I'm doing. Fannie Freddie floating debt.
What you're telling me is Fed has the best job in the world, right? They get to, basically, screw up one way, then screw up the other way, but they keep themselves employed the entire time, right? So with that said, I want to shift gears a little bit away from kind of the economy, right? And kind of shift gears a little bit, right? But really, kind of given the state of the world today, right? The question I had is ultimately, what are you changing in your investment strategies? And then the second question I have, and I want each of you to answer these, right? The second part of that is really outside of real estate. And again, all of real estate as a whole, outside of it, what are some interesting opportunities that, you're kind of aware of, you're seeing that you think, hey, this is something that maybe is not being talked about, seen, et cetera. And, we'll shine it on a couple thousand people and then talk about it. Who wants to go first?
I'll go. So we are looking more at the market than I feel like we ever have before. Again, when I say like we can't predict the future, but we can predict trends. So I'm very much looking at like, where are people moving? Now, when it comes to the mobile home park side, which we do, half mobile home parks, half apartments. Mobile home parks, I don't care as much because it's just a smaller thing. Like I'm more going to buy in a tiny little area. And I don't want to buy in areas where we're declining, but I don't care as much. But I'm making a bet on a $80 million property. I'm looking and saying, where are people moving? Because again, like I can't predict where rates are going to be. I can't predict a lot of stuff or what the Fed's going to do or what the gas is going to do over in Europe. We can't predict any of that. But if I see, tons of people moving to certain areas, again, that's why we like Texas a lot. That's why I know a lot of these guys are Texas people. That's why we like Florida. We like these areas where people are moving there. When I look 10 years out and I see the amount of population trends, that's where I want to make my bet. They call it an asymmetric bet, which is like a bet that has a larger upside and a lower downside. I'm a big fan of making the asymmetric bets. And I think the best way to do that is through really paying attention to the market and the sub-market, getting in front of that progress or an area that should be, significantly bigger than the future. And then as for like areas of, I guess your question, Feras, was like, what areas of investment
outside of real estate? What are some interesting investment opportunities? And don't tell me you're writing books. All right. Not everybody can do that one.
No, but it is on that front is just having a personal brand. The more people who know, like, and trust you, the more options you have for anything in your future. So whether you're really good at like LinkedIn or Facebook or YouTube, right? The more people who know, like, and trust you, the more chance you have of success in any area later on. Like I could go launch a fitness company tomorrow. I'm not even in shape, but I'd probably be okay with a fitness company because people know, like, and trust me. And so they would probably join my fitness company. So yeah, investing in a personal brand, I think, is a wise choice at this part of human civilization.
I like the contrarian answer. All right, next up.
Contrarian as well. So firstly, I might be the only guy on this panel that believes that multifamily is not the number one asset class for the next 10 years. It's a component of multifamily that is. So we all look at black swan events like 2008. 2020 was a true black swan event, right? And so we look at what are the things that fundamentally changed. So one of the things that we talk about is, work from home, was key. So people are like, office may not be a good, thing to invest in anymore. So that's pretty common. But one of the things that I feel like people really haven't absorbed is this. There was a one-time, unlikely to be repeated event of massive increases in single family home prices in the US. I mean, those increases were basically 5 years in one, right? So in 1.5 years, we got 5 years of increases. So we look at that and say, okay, this was a true one-time event. And even if they come down 5 or 10%, they're only giving up a small percentage of that gain, right? So what changed? This is a huge thing. What changes because of that? The answer is this. We've now put 5 million well-to-do American families out of reach of single-family homes. 5 million brand new, well-to-do families, usually with 2 incomes, with incomes over 100,000 that cannot buy single family. Here's the thing. They don't want to live in apartments. They want to live in a home. The asset class that is going to be the strongest in the next 10 years is the one that every institutional buyer in the US is targeting right now. It's built to rent. I look at that asset class because it's the only one that actually gives people what they want. They want to either live in a home, or if they can't afford that, then they want to live in a townhouse. But they want the amenities. They want that pool that they got at the Class A apartment. They want that gym. They want all of those benefits. In my mind, that's the asset class that's number one. With multifamily still coming in at number 2. Even in 2 years ago, I thought industrial was the number 1 asset class, with multifamily coming in number 2. 3 years ago, it was self-storage at number 1 and multifamily at number 2. So multifamily is evergreen. It's just an incredible asset class, but it often isn't number 1. So to me, that's one of the things that I'm focused on. Is it stopping me from buying value add? Hell no. We've had 3 meetings today on offers we're making this week, right? Just nitpicking about those offers and how we get there. So never stop buying multifamily, but look at built to rent, because we think that is a one-time 10-year opportunity, almost entirely created by COVID, because of that massive 5 million family jump that we took. Now, I also want to give you 3 that are favorites of mine that have nothing to do with real estate. Or maybe one of them has something to do with real estate. Number 1 is companies that make solar components. I can tell you that because geopolitics are worsening, the American order is coming to an end. This is something you should read about or watch with a guy named Peter Zeihan, Zeihan. If you don't watch his videos, you really need to. The American order is ending. That's not bad news for America. It's good news, but after some trouble. And oil supply in the world and gas supply in the world is going to become intermittent, which means that there are going to become countries out there that are less fortunate than the US. We are very self-sufficient, that will have no choice but to go for solar, even if they don't like solar. You're going to see solar component costs absolutely go through the roof, the same way you've seen lithium costs go through the roofs, right? Everyone in the world wants to make batteries right now, but we've missed that boat. Lithium is already 10 times more expensive than it was 10 years ago. We missed that boat. Solar components, though, are going to go completely insanely through the roof in the next 5 or 10 years. And I'm not much of a solar guy or a green guy. It's just supply and demand. So that's one suggestion that I have. Second one is Mexico. Anything in Mexico, a business, land, is a great opportunity. We are seeing incredible amount of deglobalization happening in the next few years. And I can tell you this, the US will bring some of the China the stuff that's happening. You see what's happening right now, right? There's people talking about Nancy Pelosi's plane being shot down simply because they're going to Taiwan. China is flexing its muscles. Everyone else is afraid of them. We still need China. We will still need China 20 years from now, but some component of that is going to come back. And we're going to see the Americas, Canada, Mexico, and the US become much closer partners. Anything that you do in Mexico today is going to make an incredible amount of money in the next 5 years. Nothing to do with real estate. The last one is land with water rights. I don't care if you understand climate change is real or not. It's irrelevant. What everybody understands it is that the US is running out of water, right? You look at Canada, I just changed to turf because they're only allowing me to water my lawn once a week, and they're feeling rather generous when they're saying once a week, right? I mean, obviously it's going to, it's going to burn. So we're running out of water, and land with water rights is an incredible opportunity in the next 10 years. I think it's completely underpriced.
So I should go buy a lake, build a house there, and put solar on top of the lake. So I kind of get
and make it built to rent.
Right? So, all right. Perfect. Well, thank you, Neal. So let's see. Ken, you want to go next? Same question.
Yeah, of course. Well, I think the hottest market for real estate, if you just look at the last 5 years, has probably been industrial. The last mile industrial. So think of, everybody wants something tomorrow, and so mostly on the outskirts, but now some of the malls are being repurposed around the country, and there's all kinds of there's a lot. The industrial cap rates are very, very low, and people are, obviously we always think of Amazon, but just think of every other company trying to produce products and have them to the consumer quickly. So I think industrial is going to continue to be a massive, massive opportunity for a lot of people. And there's even an article on Globe Street recently that said industrial developers are actually running out of land in a lot of these markets. Personally,
cheap land.
What's that?
Cheap land.
Yeah, cheap land.
They're running out of cheap land.
Good point. Yeah.
And just to add too, it's all like you just said. I think a lot of people have that misconception that it's the Amazons, right? These massive warehouses. Is absolutely not, right? It's all of the other guys that are trying to get off of Amazon, have their own storefronts, have their own stock. Yep. And I was talking to an industrial investor, and it was just kind of a little eye-opening, right? That it's not about, hey, let's go build a massive warehouse that you can't even see the end of, right? It's really more about, hey, let's go solve specific business scenarios.
So those areas are, personally, I've done a number of things. We've done self-storage development. We've done very well with those. And inside of those, I've actually done cell towers, which you can monetize. And I've also done wine storage, which is a very niche business. But, think of self-storage, wine storage, you basically rent small boxes for around $250 a month in a cold storage. So there's a lot of little things like that. I've done billboards. I put billboards on properties, and I bought billboards. And so you think of what a two-sided billboard is called a static billboard. I buy the billboard, put up what they call new ironed with digital. And so all of a sudden you got 4 advertisers per side every 15 seconds. So we've quadrupled our revenue and of course the price. And I've sold some of those to Clear Channel recently. So those are some other little fun things that I've been doing on the side, within the real estate space. And you can do those if you buy a nice property along a freeway or on a corner. Some of those little things, they add up. And those billboards, we're selling them, in the millions. So once you get them all set up, they're reoccurring revenue, and the cities don't like them anymore. And so it's almost like the mobile home parks, they don't want anymore. So those have been pretty fruitful for us as well.
I'm hoping you have plenty of them here in Houston, because I like to say Houston is just billboards as far as the eye can see.
Robert, your thoughts on opportunities?
Yeah, so this has been great, and I hope that folks have expanded their mind beyond just multifamily, which we all love, right? Bread and butter, and all the reasons we love it. But I do think there is a caution. I totally agree with Neal on build to rent. That's a space we've been involved with for the last few years. It's worked really well. The challenge, of course, is the build part. Construction and the supply chain and all that stuff you've heard ad nauseum. It's real. Our friend Chris Martinson says, if you make a product that has 400 parts, and you can get 399 of them, but not the 400th, then how many can you sell? And the answer is none. You don't have any unless you have everything. And so that is certainly a challenge. But remember, when there is new construction in anything, it automatically raises the price of everything around it. When a developer can build, develop, and sell into the market at a profit, that helps everybody. There is a housing shortage. So we're big believers in that. At the same time, I've spent a decade investing in agriculture. because I think agriculture is a huge opportunity. There is a calorie crunch upon us. I don't want to eat bugs. I don't know about you. So there's great opportunity there. I think outside of real estate, I love cryptocurrency. Now, I'm not one of those crazy, weird crypto guys, and certainly I was exposed early, but at the same time, I love metals. I love
I'm gonna
metal.
ask you if you have the coin. I know Robert well, and he always has a gold or silver coin on the guy.
Always. Now, metal is not an investment. It's not, but it's a great hedge. And there's reasons. The best thing about this ounce of gold is it has zero counterparty risk. There's not any counterparty risk unless you know where I live and break into my house. Think about everything you invest in via the counterparties that are risky to you. Even if you own real estate free and clear and you don't pay your property tax, they're taking it away from you. So there's counterparty risk in everything. Having said that, another one of my favorite investments outside of real estate is to invest in businesses. And moreover, today, as much as I am very hands-on, very active, we're in the development business, I love to give the ball to somebody else, to passively invest. So you asked earlier, Feras, what can people do? Find great operators that are doing awesome businesses with excellent track record and come alongside them, right? Why would you try to compete with Ken McElroy or Feras when you can just invest with them? I think it's a tremendous shortcut. It gives you exposure to markets and teams that you probably aren't going to be able to get exposure to. And when times are challenging like they are, it lets you play the field a little bit. So I'm a big believer in watching carefully who's doing a great job, who has a great reputation, and then partnering with them.
Well spoken, Robert. Thank you.
$20 for that one, Robert.
Appreciate that. No, but I mean, I think Robert brings up a good point. There's a lot of different ways. And I like to say, basically, like Ken mentioned, I mean, we underwrite 1,000 deals a quarter almost, right? I think about 4 months to write 1,000 deals. Someone has to compete against that, right? And there's the bigger guys too. So it's interesting. And I think that's usually the best shortcut. Really quick. So I do want to do some Q&A for people, right? And for those that are watching, there will be an email sent out with the recording, as well as, I guess, people really want the chat log. So we'll make sure that's in there too. And we will basically do about 10 minutes of Q&A, and then I'll let everybody close out and just kind of give a quick recap on their business, what they're doing, where they're at, and also how people can get a hold of them. And so with that said, I was trying to find the best questions, but I do want to ask a very simple one for everybody. I'd like everyone to ask, are rents going up or down in the next 3 years? And if so, let's just say 3 years, what do you expect them to go? What percentage? Neal, you get the answer last. I don't want you to seat anybody. So Brandon, you want to go first?
Sure. Can everyone still see me and hear me okay? I had to switch from my computer. It was dying.
We can.
We got you.
All right, good. Where are rents going? All right, so I'm not as smart as these fellas, but again, it goes to what I said earlier. If you buy in areas where lots and lots of people are moving and there's not enough housing and that problem is getting worse, I expect them to go up. I think that the biggest risk we have of rents going down is political. I think that if people get too upset, the government will enact more strict rent control, maybe nationwide someday. Who knows? But I think that's the biggest risk is that. But yeah, if I had to guess, I'd say rents are going up in certain markets.
All right. Let's see, Robert.
Rents are going up, absolutely, but don't get too excited about it. We talked about this in Seattle. Inflation is not all that bad for apartment owners because the value of your property is up and the rents are up. But a lot of persistent inflation is not good. When your tenants can no longer afford food and gasoline, that's a problem. So I think rents are going up, but they're going up because we are printing trillions and trillions of dollars. And when you do that and you have inflation, then there's going to be more available dollars. One of the slides I often use is the price of a cup of coffee for the last 60 years. And people look at, wow, I could buy a cup of coffee for 4 or 5 cents. The coffee hasn't changed that much. Yeah, maybe it's a little better, but not really. What's happened is the value of the dollar has consistently gone down for 100 years. The trend isn't up for debate. It's obvious when Neal shows you the chart. Dollars are worth less every minute. So rents going up, that's not enough to hang your laurels on. That's why Brandon said an awesome thing, and hopefully you got it, but it's not buy anywhere. It's buy in specific areas. Ken was really clear on the 4 states he invests in, right? We all have niches, and we get rich in a niche within real estate in something that we know well. So I think overall rents are up, and I think the trend for rents for the next 20 years is up.
Awesome. Thank you, Robert. And Ken, you want to go next?
Sure. Yeah. Well, first of all, I think people didn't understand that real estate only does well if there are people there. So that's, so the migration patterns, things we follow, like a lot of people, we follow moving vans. It's simple, but easy. Out-of-state driver's licenses being turned into markets. Those are all leading indicators of people actually moving to a market. One of the new things that we're following is what we call office utilization. So if you take a look at, if you look at the work from home, there are markets that literally like Austin right now is 56%. Houston, I think, is 45. So you start to look at the top 10 metros, the office utilization. What that basically means is that originally we all used to take a look at, employment hubs. Well, I think things are very different now. So you have to be looking at potentially some of those submarkets and where people are. So because real estate does not work if there aren't people. Not everywhere is growing. I mean, I think it's St. Paul. I don't want to pick on St. Paul if it isn't true, but I think they initiated a rent cap in 2021 of 3%. So what does that mean? That I spoke to one of the top lenders out of San Francisco. They said they basically just crossed it off their list. So anything down the coasts, St. Paul. So you got to look at where the money's flowing. I'm talking about the big money. I'm talking about the debt. So, they're also looking at the same stuff we're all looking at, and they want to be paid back. So I think that the markets that are attracting people, the migration patterns from safety, from weather, from the political issues, with around the funding the police and all those kinds of things. I'm not trying to be political here, but people are making choices with their feet and their wallets on where they want to be. And it's really very easy to see bubbles all over the place. And there's massive opportunities in the markets because of this.
Yeah, de-risk it and then let the wave carry you forward, right? So that's kind of the MO. All right.
Feras, I'll give you specific numbers on rent growth.
30 seconds. Go for it.
30 seconds. So I believe rent growth in the next 3 years will be 6, 5, and 4%. As simple as that. That's 10 seconds.
I like it.
6, 5, and 4.
That's kind of what I would say too. So, all right. I like this question because it kind of touches a little bit on what everyone is saying is we have a demographic wave staring at us in the face. 35 million millennials coming to age to purchase a home. They can't afford it now. What will they do? Some can't even afford to rent in metro areas. Will they rent at home or will they move to a submarket/suburb? I'll let whoever wants to answer that one go for it.
Not everybody wants to own a house. That was the American dream when I was growing up. But today, a lot of the millennials and the younger folks looked at their parents who got decimated in the great financial recession. And they're like, why would I do that? They share everything. They don't even own a car. They Uber, so I don't think that's the metric anymore. But I think what they do with their money, there will be a great opportunity for all of us to come alongside that and profit. So you got to really get your head around the way they behave and the way they think, which is different than older folks do. And every time there's a change like this, a demographic shift, there's a new opportunity. I think we'll see that in the next few years.
So what you're saying, Robert, is we should all invest in like avocado toast because
pretty much.
If millennials survive.
If you're not already in avocados, it might be a little too late.
I love it. Anybody else? I love my avocado toast.
I think millennials, if they don't buy homes, they'll have spare money to invest. They're the second largest generation of all time, just behind the boomers. And a huge amount of the money that boomers had early on in their life went into the down payment for their homes. And what I'm seeing is that the millennials are actually more active in investing because they're not buying those homes. And I think they will drive all sorts of product markets up, whether it's stock markets or commodities markets or real estate. So there's actually an interesting thing there that you have a generation that's slightly smaller than the boomers that actually has more investable cash. I know there's poor millennials, but we're talking about the rich millennials that were just on the borderline and didn't buy a house. Well, they've still got money in the bank. They're investing it.
No, I think that's a great point. I think it's a lot of Brandon's audience, right? People that aren't even owning their own stuff. They're doing house hacking. They're basically taking that money and investing it and actually growing their wealth a little bit more quickly than most people do.
And they're living in Neal's build to rents.
Absolutely.
Soon, soon.
Yeah, you want to be the guy owning the apartment. Ken, were you going to add something there?
One point. Yeah, I just want to make one point. I also think that most of the millennials have only seen an upward trend. And so, for the last however long, 10 plus years, all they've seen things has been going up. I don't know that that's very realistic moving forward. And the other thing is a lot of them are heavily in student debt. And I know a lot that are hindered with thousands, hundreds of thousands of student debt, which actually keeps them in the renter market. I mean, I know doctors and some professionals that are make pretty good money that have thousands, hundreds of thousands of dollars in student debt. So there are other factors at play here as well, and I think they feel like there's time.
Yeah. That first point you made about the rising market, though, I think that one's always intriguing to me, right? I came from tech, worked at Microsoft. I know many people, all they know is the stock market. Every dollar they save is dumped into the market. And with kind of the recent crash of the market, right, it's kind of interesting. So people have less investable cash right now, or they're scared to. But at least I think it's kind of a wake-up call for people to, hey, like diversification is a thing, right? Whether it's real estate or crypto or, solar farms, whatever it is, right? I think it's a little bit of a wake-up call. And I think that'll actually help burst that stock market, bubble. And I think, like Robert wants to say, moving money from Wall Street to Main Street, right? That's the big push. So, and so I'm going to ask one last question and then we'll kind of wrap it up. But the question is ultimately, if we do have stagflation, what buying opportunities do you guys see kind of coming up? That's a hard one. So that's why I picked it.
That is a hard one.
Produced a little bit of an interesting conversation.
Yeah. The short answer is this. I do not believe in a stagflation scenario. When I look at the Fed, they are awesome at killing inflation, and they have no upper cap to interest rates. Stagflation assumes that somehow for years and years, we will have high inflation. But I just fail to find those kinds of scenarios in history. We saw that in the 70s, but very, 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 very different market. Remember, the US was not self-sufficient with oil. We are the world's leading oil producer. We're selling oil and gas to other people. It's extremely difficult for us to suffer from stagflation. The Fed prefers the other scenario, which I also prefer. Push the economy down, go into a short recession, reset inflation, move ahead. And there's no way that any one of us can stop the Fed from doing that. There's no long-term stagflation scenario.
All right. Well, that's Neal's very, very strong opinion. Anybody else?
Yeah, I agree with Neal. I think the Fed is really going to aggressively push down inflation. The one thing is we got to be careful of is you don't want to be too heavy in cash. So, you got to have cash reserves, as we talked about, but in the same token, if your cash is being deflated away through printing and through these other things and inflation, then you're better off in a hard asset. That's why I like fixed rate debt. So if we just subscribe to the fact that, let's get $1 billion plus in debt at, let's say a coupon of 4%, because now I know that I'm beating inflation by a long shot. And so I'm using other people's money at a fixed coupon. Why wouldn't I do that? So that's been our I believe back in the day when I was younger, cash was an asset. Today, debt's an asset. Cash is a liability. I believe it's flipped.
Awesome. Anybody else? All right.
I would just say that stagflation, I agree with Neal. If we see it for real, it's short term. I mean, yeah, there's persistent inflation, but what we don't have is the big unemployment that comes along with that. And that's something that would be very short-lived. So you look for what an opportunity would be. It would be kind of a short-term opportunity. It's not going to be the buy and hold farmer mentality that I think most real estate investors really need to adopt long-term.
Awesome. Well, then I'll ask one last question to kind of wrap it up, which really summarizes a lot of these questions, right? Now I'll steer this towards maybe Robert and then Brandon, but really, how should people get started today? What should they keep in mind?
Well, I think the big key everybody has is, and maybe you said Brandon first, I'm sorry.
No, go for it.
Is that you got to be sharper than ever, right? When markets are just going up like crazy, like they were in 03, 04, 05, I mean, you didn't have to be very bright. You didn't have to pick a market very well. You didn't even need an awesome team. You just needed to do something with your money. today you got to be sharp. You got to pay attention. Congratulations for investing an hour to watch this, and don't let that be the end of it. And don't get overwhelmed. We throw around a lot of terms and jargon and so forth. If you don't understand, make a note and research it. Easier than ever before. There are great opportunities to learn. Webinars, podcasts, live events, meet people doing it. And today more than ever, we need that community. It took us all about 15 seconds to say yes to this, because it's like, why wouldn't we all want to hang out and learn from each other? And there might be a few thousand people that like to listen as well. So I think the big thing is just to keep your head in the game. Don't get delusional about it. Don't get freaked out about it. Stay the course, be even keel, and know that 20 years from now, it's going to be 20 years from now, whether you do anything in the meantime or not.
Yeah, and you hit it right on the head. It was surprisingly easy to get all these guys basically a 1 week notice to free up their Tuesday afternoon. So definitely, we love talking about this. We love learning. I think it's important to be that, never ending student, right? Always be a student learning and kind of, and taking information from everything around you. Brandon, not to steal your thunder. You want to add that as well?
Yeah, I'll just add on to what Robert just said there, and I've been saying this a lot lately. Is like, number one, there's 4 things I want to point out. I think to thrive in a uncertain future, I'll say these 4 things. Number one, like Robert said, you got to be smart. You got to do your research. You got to be nimble, meaning you got to change with the information that you get. You got to be aware of it, but also you have to be, I believe, specific. And what I mean by that is, back in 2012. Pretty much anything you bought was going to do good. Today, there's so much competition, largely because of the internet. I mean, like, the internet changed the game because you can learn to do anything now. In other words, it's not like just a few people that are doing it. So because it's so much more efficient today than it used to be, you have to be very, very, very good. And so the idea of like, I want to do 50 different types of real estate, just kind of go with whatever I feel like doing, I don't think works in a rough economy. I think you need to be very, very good and sharp. And to become good and sharp, you have to focus. So get good at something that fires you up. So smart, nimble, specific. And the last one is bold. A lot of people have been talking for the last 10 years. I've been saying it. I can't wait for the economy to get, for economy to go bad so I can start buying real estate. Guess what? It's your time. Like, we're ready. Like, are you ready? Like, you got to be bold. You got to, like, there are no guarantees in life, but I'm already starting to see the same messages of like, well, the economy's kind of rough right now, so I think I'll wait until it gets better in a few years. And I'm like, wait, like, yeah, what are we talking about here? Like, yeah. So smart, nimble, specific, and bold. That's what I say. And follow these guys. I mean, I learned from all of these guys a dramatic amount. I don't know if you guys know the background, but like, Ken, I read ABC's Real Estate Investing. I got into real estate, multifamily, because of that book. I was listening before the Bigger Pockets podcast ever happened. I was listening to Robert every week on the Real Estate Radio guys.
Stars.
What?
They're stars.
Oh, they're stars, right? And then Neal, last week or 2 weeks ago, whatever, at this presentation, I was like taking notes frivolously and taking photos of all your slides. I'm like, this guy is legit. So, and of course, Feras, you and I run a lot of cool apartment stuff together. So obviously I trust you guys. So follow them on social, follow them wherever they're at, get their newsletters, learn from these guys. That's how you stay smart, how you stay nimble, how you stay specific, and how you stay bold. So that's my closing remarks. And grow a beard.
Oh, the beard's a little bit harder for some of us. All right. This is about the best I can do here. All right. Well, so with that said, for those of you watching, thank you guys for taking time. I know there's a lot of people that want to know how to get in touch with the hosts. I wanted to let each of you just give a quick recap, 10 seconds, what your business kind of focuses on and how somebody can get a hold of you. And then after that, I'll kind of close it out. Neal, you want to go first?
Sure. I'm the only Neal Bawa on the World Wide Web. Simply type my name into Google and hit the links. There's lots of useful information. That's probably the best way to connect with me. If you're looking to invest, the logo behind me, Grow Capitus, no WGROCAPITUS.com. We have about 800 investors. Multifamily, built to rent is what we are mostly focused on. Though we try some other interesting things as well.
All right. Thank you, Neal. Ken, you want to go next?
Hey, thank you. Yeah. So obviously go to Ken McElroy at kenmcelroy.com, and I've got the YouTube channel and all the videos we put out and all that. Our company.
Can you spell that, Ken?
Yeah. our company is MC Companies. So mccompanies.com. all kinds of great information on there, and happy to chat with you guys whenever with any questions you might have.
All right, and Robert.
So the Real Estate Guys are on a podcast outlet near you. You can find us at realestateguysradio.com. Actually, if you'll send an email, I'll put it here in the chat to MFIN. That's the event we were just all at together. MFIN at realestateguysradio.com. You will automatically receive all of our propaganda, and we'd love to have you listen. We need more.
Love the propaganda term. I need to steal that sometime. Brandon.
Yeah. So unlike Neal, I am not the only Brandon Turner on the web. So there is one that teaches there's 3 teachers out there. One teaches skateboarding, one teaches how to overcome your drug addictions, and then I teach real estate investing. So you can Google me and find me that way. Beardy Brandon on Instagram, and odcfund.com. That's where we do all of our real estate stuff. ODC, Open Door Capital Fund.com. And that's not the same Open Door as the iBuyer. People get confused with that. This is a different. I had the name first.
All right. Well, gentlemen, thank you guys very much. Really appreciate you guys taking some time out of your days on short notice, really, to kind of help and kind of really educate everybody, right? Like we tell people, the best investor is an educated investor. All of us love doing this. We want to share what we know. We want to share what we don't know, and hopefully we can learn from you. And so really appreciate it. For those watching, we will send out a recording afterwards. And with that said, let's go ahead and call it a wrap. Thank you all very much.
Thank you, Feras.
Thanks, everybody.
Thanks, everyone.
Thanks, Ferris.
Bye-bye.
Everybody have a good evening.